you can make a policy over tightening or a monetary error, and therefore only find out about it 3 to 6 months afterwards. And I think that's what the markets are more fearful of at the moment, that there'll be an over tightening by the Federal Reserve as it tries to adjust to lagging data, which unfortunately is not necessarily going its way.
As far as investors are concerned, long term, we live in a deflationary world. So you can take from that this inflation scare is going to be temporary. Now, temporary doesn't necessarily mean a year. It could mean 2, it could mean 3. But long term, interest rates are going to go back down, and we're going to go back into a deflationary environment.
Seems that this elevated rate hike expectations are going to last for a while. It now seems that the Fed is in line for another 75 basis points hike in September, followed by possibly a series of 50 or 25 basis points, taking the terminal rate to somewhere close to 4%. Now, this is a wildly shifting narrative. In fact, if we were to think about this terminal rate 6 months ago, it would have been nowhere close to 4%.
Both core inflation, headline inflation on a year-over-year basis anyway, is so high that they really don't know where they want to get to, and more importantly, what the impact of all the things that they're doing is likely to be on the global economy. And that's why they keep talking about that this tightening phase will lead to some level of economic pain without stating what that level of economic pain is likely to be. On the other hand, they're talking about a soft landing. So they're talking from both sides of their mouth without really knowing where they're headed. Very unusual situation for the Fed over the last, let's say, 2-3 decades.
Everywhere, equity investors are of the belief that the Fed tightness is temporary. Right. So if you look at expectations, people are talking about the Fed funds rates crossing 4-point-some% by March or June next year. But thereafter, the market is pricing in rate cuts. Or let me to put it another way, the Fed is trying to break something by tightening liquidity and raising rates, and the market recognizes that the Fed will tighten until something breaks. But the moment something breaks, the Fed will come back and give me more money and be supportive. So the market's already looking through the failure of liquidity and starting to look through to the fact that the Fed will eventually become supportive. The risk, of course, is that presumption proves incorrect and that the Fed remains tighter for a variety of reasons that could happen.
So we think that they will do 75. 100 would be out of character. But having said that, they have been out of character in the last three FOMCs. But our baseline is that they'll do 75. But that's not the important part. The important part is what do they indicate about November? What do they indicate about December? And what do the dots say about 2023? If the dots move up in a substantial manner, if they indicate that they will remain at the same pace in November, I think that's the part that the market, I don't think, is pricing in.
Because the US is not going into recession, the Fed will not get the kind of disinflation that a recession would have ordinarily brought about. And you saw the last CPI number was ugly, the US CPI number. Yeah. Core CPI month on month at this stage increasing 0.6%. Let's hope it's an aberration. But the Fed can't be hoping at this stage. So what we think is going to happen is you'll get another 75 basis point hike this week. 3 things. Number 1, that's the hike this week. Number 2, there's a good chance that when we get the dot plot, that the Fed is going to signal that the terminal rate is now above 4%. We think it'll be 4.25% for now, and it could go up later. But more importantly, I think there'll be a strong affirmation that no rate cuts are coming in 2023.